Have you ever heard of a company losing over $100 billion in just a few days? This isn't a movie plot. It's the real story of the Adani Group's spectacular crisis in 2023. How did a business empire that seemed unstoppable suddenly find itself on the brink of collapse? Stick around as we unravel this incredible financial saga, from its meteoric rise to its dramatic downfall, and discover the crucial lessons it holds for all of us. Let's start from the beginning. The Adani Group, led by Gautam Adani, began its journey in the late 1980s as a modest commodity trading firm. But over the next few decades, it exploded into a massive conglomerate, dominating India's ports, airports, energy, and infrastructure sectors. Its growth was breathtaking. The group's strategy was aggressive expansion, acquiring assets and launching ambitious projects at a dizzying pace. By early 2023, Gautam Adani had become one of the wealthiest people on the planet, a symbol of India's economic ambition. The company's stock prices were soaring, seemingly defying gravity and making investors incredibly happy. On the surface, it was a picture of incredible success. But underneath, a storm was brewing. The secret to Adani's rapid growth was also its greatest vulnerability: debt. The group borrowed heavily to finance its expansion, accumulating a mountain of loans from both Indian and international banks. This strategy is known as a debt-fueled expansion. It works well when everything is going up, but it creates a fragile house of cards. Think of it like a spiral. The company takes on debt to buy new assets. Those assets are then used as collateral to borrow even more money for further expansion. As long as the value of the assets keeps rising and profits roll in, the cycle continues. But if something disrupts this flow, the entire structure can come crashing down. This over-leveraging, or relying too much on borrowed money, set the stage for the disaster to come. So, what went wrong? Several key mistakes contributed to the crisis. First and foremost was the extreme over-reliance on debt, which we just talked about. This made the group highly sensitive to any shocks in the market. Second, there were serious concerns about the group's corporate governance. Critics pointed to a complex web of offshore shell companies, particularly in places like Mauritius, that seemed to hold large stakes in Adani's publicly listed companies. This lack of transparency raised questions about who was really controlling the stock and whether the share prices were being artificially inflated. A third issue was the concentration of power. The Adani family held significant control over the group's various entities, leading to worries about a lack of independent oversight and accountability. These factors combined to create a higher-risk environment, a bubble waiting to be popped. The moment of collapse was swift and brutal. On January 24, 2023, a US-based investment research firm called Hindenburg Research published a bombshell report. The report accused the Adani Group of engaging in what it called brazen stock manipulation and accounting fraud over decades. Detail the complex network of offshore entities and alleged that the group was using these to artificially boost its stock prices and financial appearance. The report landed like an earthquake. The market's reaction was immediate and catastrophic. Investors panicked. In the days that followed, Adani Group's stock prices went into a freefall, wiping out more than $100 billion in market value. The crisis forced the company to cancel a crucial $25 billion share sale, a move that was meant to raise capital and reduce debt. The dream run was officially over. The fallout wasn't just limited to India. The Adani crisis sent shockwaves across the global financial community. International banks and investors who had lent money or invested in the group faced potential losses. It raised serious questions about the stability of the Indian market and the effectiveness of its regulatory bodies. The scandal became a major headline worldwide, putting a spotlight on corporate governance standards in emerging markets. It served as a stark reminder that in our interconnected global economy, a crisis in one corner of the world can have far-reaching consequences. For global investors, it was a painful lesson in due diligence and the risks associated with opaque corporate structures. So, what can we all learn from this incredible story? First, if it looks too good to be true, it probably is. Sky-high valuations fueled by massive debt are a major red flag. Second, transparency is everything. Always be cautious of companies with overly complex and opaque structures. As an investor, or even just an observer, you should be able to understand how a company operates. Finally, this story highlights the timeless importance of sound financial principles. Diversification, avoiding excessive debt, and focusing on genuine, sustainable growth are principles that stand the test of time. Whether you're a multi-billion-dollar corporation or managing your own personal finances, the Adani saga is a powerful cautionary tale about the dangers of ambition without accountability. Thank you for watching. If you found this breakdown insightful, please hit that like button and subscribe for more deep dives into the stories shaping our world. See you next time.